it's a big forward leading indicator. So you just can't react to everything you hear day to day.
Well, and these will be conversations we're going to have, I'm sure, over the next 12 months, given an election year.
For
and
sure.
People are thinking, should I modify my portfolio based upon X, Y, or Z regarding politics? And like Adam just explained, everything has already been priced in on expectations, whether it be geopolitics and things like that. So any decision you're making is after the fact.
Hey, welcome everybody to the October rendition of our monthly Market Matters. Talk a little bit about what's happened in the markets and the economy, and maybe some of the whys behind that. We'll just start out with some returns like we always do. S&P 500 is down about 3 month to date. Year to date, it's still up just under 10%. The NASDAQ is down about 4%, close to 4% month to date. Year to date, it's still up over 22%. The MSCI World, which is basically all of your stocks outside the U.S., month to date's down about 4.5%. Year to date, still slightly positive, up about 1%. And then you got your bond index, Bloomberg Aggregate, for the month is down about 1.3%. Again, rates have moved back up, and year to date it's down about 2.5%. So again, still trending downward. Commodities month to date were the only thing that has been up, and it's just up slightly, just over 17 basis points. And year to date, though, it is down about 3%. Just to kind of refresh you on where we're at, since August 1st, equities are down about 9 to 11%. So while everything's still positive, since August, September, and October, so basically last 3 months, we've had a little bit of reversal in market movement. So equities are down about 9 to 11%, bonds down about 4%, and the 10-year yield's up from 4 to 5%.
Yeah, the summer seems to be holding its history. Heading into September, October, historically are remembered as being more difficult months, and it looks like this one's following suit. And so, depending upon the type of portfolio you're in or the type of investments you have, it's most folks are kind of feeling sideways, where it went up, went down, went up, went down, and now that we're kind of we're heading into the fourth quarter here, it's been a little frustrating watching the summer give back a lot of the earlier year gains. I've got a couple of visuals. I'm gonna have Becca pull up 2022 first on the S&P 500. Becca, there we go, perfect. So what we've got here for those that are watching, I've got two different charts here I'd like you to see. So the orange line is the one that you usually see on the news, the S&P 500. Those are the ones that'll grab the headlines. The purple line is the exact same fund, except instead of being weighted by size, where Apple Computer would have the biggest share and so forth, it gives everyone an equal size. All 500 stocks have an equal weighting. And so typically these will move similar. If I showed you a chart with these going back 15 years, the lines often lay on top of one another. And so you can see in 2022, tech companies got more abused. And the S&P 500, which is heavily weighted in the big 7 tech stocks, was down more last year. And now if I flip it back to this year, to 2023, you're going to see the huge outperformance. And so the 500 companies evenly weighted are actually down on the year. That part of the market is actually down about 3%. And the only reason why you're seeing headlines of the stock market up, nearly double digits or over double digits, depending on which market, is really based upon these 7 tech stocks that have been kind of hopped up on AI. But for the most part, these 7 tech stocks have just been recouping gains that they lost last year. There were a lot of tech stocks that were down 60, 70% last year, and now they clawed a lot of those gains back. So when you stretch the chart out over a couple years, they've really been flat, just kind of like the major markets. But that shows what my point there was to show the breadth of the market may not be quite as healthy as people feel just by looking at a quick snapshot of the headline.
For sure. And we've talked about this before where, start and stop date is so critical. We always use year to date, but if you're year to date in February and you're year to date in October, that's a quite different time period, And then you go back 1 year, 3 years. Start and stop is so critical. And then you think you're getting all the information when you use an index, but like Jason just pointed out, is it cap weighted or is it equal weighted? And a 12% difference year to date is a pretty large difference in the difference where you literally have the exact same companies in the index. It's just how you're weighting it. So again, that's why we try to do this and dissect a little bit of this information, so you just don't see headlines and then think, oh yeah, everything's going great. Let's talk a little bit about bond returns. So bonds have kind of been the story, and they, it sort of goes back to the whole inflation thing, massive inflation, rise in interest rates, decrease in bond prices. So right now, the 10-year Treasury bond is down about 5%, and it's on pace for its third consecutive annual decline. And I think we mentioned this before, data going back to 1928. This is going to be the first time in history we'll have a 3 years in a row, 10-year being down. So it's the worst 3-year period for bonds since 1978, 1980. And cumulative decline of negative 26%. Becca, if you want to pull up that historical bond returns chart. So you can see there, that's where we are today at 2021, 22, 23. Obviously last year, big down year, but again, still down this year. So
for a quick explanation for some of the folks listening, the reason why bonds really sold off again this summer, the 10-year Treasury jumped again. A lot of people thought the government would be close to be done raising rates. We thought that inflation might have been more curbed, but it looks like, as we're all hearing that word stickier, and it's hanging around a little bit longer, than the fear that they may have to raise rates more or at least keep rates higher longer. I think the 10-year jumped from 4 to 5 pretty quickly over summer. And then that added a little bit more pressure onto the bonds, which is what, Adam, what you're explaining there.
Yeah, for sure. And a big part of that is the flattening of the yield curve, which means, at first you raise rates where the Fed only controls the short end of the yield curve, which is the, basically immediate rate. And then the market controls the rest of the yield curve. And so rates went up right away. The Fed controls that part. But markets still had the longer end of the yield curve at a lower rate because they thought, well, they'll cut rates soon and we won't be in this environment very long. And if you've heard the term higher for longer recently in the news, that's kind of what the theme is now, is that, hey, these rates may not go down quite as fast as the market anticipated. We may be in the 4 to 5% range for several years versus several months. So what affects bond returns? Bond is their math. It's a conversation we have with clients all the time. So unlike stocks where it's arbitrary and you're basically guessing as to what the future value is going to be, or you're paying for earnings, I should say, bonds are math. You can figure out the price of a bond with the right inputs at any moment in time, based on, like I said, the right inputs and where the market's at. So bond returns are determined by coupon, which is the interest that you're getting paid, and the face value. Now, you may buy that bond at a premium, over face value, or at a discount less than face value. But if you hold the bond, you end up getting the face value at the end of the bond, and you get all the coupon payments along the way. So why are bonds down so much the last 3 years? Like Jason mentioned, when interest rates go up, again, we deal in marketable securities. Marketable securities are marked to market every day, which means if you need to turn your investments to cash, you know what the value is. Unlike an art collection or your house or your car, where you got to find a buyer, marketable securities have a value every day and you know what it is. So factors that affect daily bond returns. So not the value you're going to get at the end of the cycle or the end of the period for the bond, because I just explained you're going to get the face value plus the interest payments. But the daily factors that affect bonds are credit quality. So if a bond's credit quality gets lowered, then that could lower the price of the bond, or credit spreads blow out. But more common, and what's happened in the last 3 years, is interest rates. So again, I won't get into all the weeds on bond math, but
just a high level weed. High level weed. This is how I explained it to a couple clients: is that if you bought a CD or if you bought a bond maturing in the future, and let's say you locked it in at 4%, and then all the rates around us went up, and now the going shopping rate is 5. Everything on the computer is 5. The banks are all offering 5, and you still have this thing locked up at 4. Well, you hold it out. You're still going to get your money, and you're not going to have risk. But if you needed to sell that 4% prior, you had to get out. You had to get some cash. Who wants your 4% bond now when everything else is 5? So you're going to have to sell it on sale.
How do you make it more attractive?
You got to sell it on sale. You're going to take a little bit of a hit on it. You're going to take enough of a hit on it because the person's going to buy that whoever buys it from you, they're going to get face value at the end. So you got to give them enough bang for their buck at the beginning, because they're not going to make as much interest for the ride. And so the bond funds, which is just a collective average of all of those, if there's lots of bonds in there, they're automatically doing that math every day.
Exactly. And again, bonds, we just said, are math. So it's not like one bond is different than the other bonds. So if you have a collection of bonds and they all were, paying 2, 3, 4%, and now you can get 4 or 5 or 6%, all of those bonds go down. And that's all a function of interest rates. So when you see a 3-year decline in bonds without a real credit event, because I just said credit's the other factor that affects bonds, it's all interest rate driven. So that's where we're at with bonds today. But so there is some good news. So show this forward bond return slide. And again, it's a little bit convoluted, but I'll basically explain. We're in decile 4, which is where the 10-year Treasury yield is today, which is 4.5 to 5.4%. We're right around 5. And then the forward returns. So it's a very high level of confidence that basically you start in a higher yield, you're going to earn more over the next 7 years. So today, bonds are in a much better spot than they were a couple of years ago. You just had to endure the pain of interest rates rising and those mark-to-market prices dropping.
Is the assumption there, based upon your chart, is that rates, if rates are plateauing, which I think we both agree that they are, that your forward returns are far higher than if you're buying in when rates are lower?
Exactly. Yeah. And eventually, and the higher rates are, obviously this goes out to as high as rates have been. There's a good chance that eventually rates come down. I mean, again, you don't know what the future direction is. I mean, could we go to 10% in rates from here? Sure. I mean, everything's possible, but probabilities are different than possibilities. So.
Well, and what's different too. People go, oh, we could easily go back to 1981. The Paul Volcker years when rates were up around 18%. Yeah. Well, I was just reading a stat that when he was the Fed chair, the government, or I should say the country, we were about 500 billion in debt, and now we're 34 trillion.
Yep.
When they were borrowing money at 18%, it wasn't going to bankrupt the country. When you're 34 trillion in debt, we can't have 18% rates. We can't afford it. And so it's unlikely that rates will get that much higher, just because of the service on the debt is outrageous already.
Yeah, I know right now, markets are pricing in basically rate cuts in mid 24. Now, again, this is, this stuff is fluid and it changes, but eventually, recessionary forces start to force the Fed to cut rates. But that's kind of where we're at. So you want to, Jason, you want to talk a little bit about drawdowns and the stuff we deal with daily?
Yeah, stuff we deal with daily, stuff we definitely deal with annually, is that, every time the market is down, we've got, and maybe it's just because us humans, our memory's awful, but we always feel like this time is worse than last time. My gosh, this year I've probably heard 1,000 times, I can't ever remember it being this bad. And not necessarily talking about the markets, but let's just say geopolitically, obviously with what's going on globally. And I can understand those fears. And then when the market goes down, there's always that fear that, oh my gosh, we've never been here before. We've never gone through this before. And so we have. And so the first chart I'm going to pull up, I'm going to show historical corrections. And so what this is, there's a ton of numbers, a ton of math. I'm just going to summarize it very briefly. You've got years going back here, 100 years. The TR, total return, that's what the S&P 500 finished for the year. So if an investor put all their money in the S&P 500, bought in January 1st, left it alone, did nothing, by December 31st, the TR column is how much they would have made. Let's say a historical annualized rate of return of somewhere maybe around 8%.
And not to confuse you, this is your typical cap weighted S&P 500 rate of return, because we did talk about equal weighted earlier.
Correct. And so the important column here, the reason why I'm showing it is for the DD column. That's the drawdown. And so what that means is, if you're the worst investor ever and you bought at the top, sold at the bottom, that's what your return would have been that given year. So the average correction annually is right around 13%. Every single year, the market goes down 13% on average, even though it averages close to 8%. And so you can look at some of these drawdowns, because every time, I talk to folks, oh my gosh, this 8 or 9% correction, this just feels worse than it has been in the past. And it's actually not even close to the average. And so it doesn't necessarily make us feel better, but we realize that this is normal. And we've been here before. We'll be here, unfortunately, many times again.
Yeah, absolutely.
Another one that I'm going to show here is one that I've got counting down days. And so this is kind of a fun one that looks at volatility. Whether we remember on the news, if you happen to watch it, where it was a big 300-point down day or a 400-point down day or big drawdown days like that. Last year was a tough one where we can see minus 1% days. We had 40 of them last year. We've only had 25 this year where the market has been down 1% or greater. We have not had, knocking on wood, we haven't had a single day this year where the market's been down 3%. Last year, we had 8 of them.
Don't jinx it.
Back in 2020, we had 16 days where the market was down 3% or more in one day. So as far as general volatility goes, this year, which again, I was reading an article this morning from Bloomberg. This time last year, there was 100% certainty that we were going to have a recession this year. And it ends up being a light, as far as volatility go, it ends up being rather light. Last chart I want to show is this chart's called Reasons to Sell. And you could probably add a 1,000 other points on this.
Yeah.
We're never going to live in bliss, and we're probably never going to live during a time where there's world peace, no military war, conflicts, things like that. It just is what it is. And it will probably always be that way. But it doesn't mean that people stop consuming. You don't stop buying deodorant and groceries and driving your car, and life generally goes on. And so what this chart shows is every single time we've worried and thought, oh my gosh, this is the end, we need to get out of everything. And it shows little points on the chart of giant crises at the time that we were worried. And then in the background, just the financial markets just continuing to trudge along.
Yeah, and I think probably even more important than this, I've seen a bunch of these charts, and there's ones with even more data points. When you think you're reacting to something, the market has already reacted and priced it in. So you're always late. Even if you do this right at the time that things happen, things have already been priced in. So and that's always the fear. We've talked about this several times with how the market is a leading indicator. Again, we talked about the yield curve a little bit, how it's steepened recently, and that's not because anything's really happened. It's just the market's come to the realization that we may not be cutting rates in the future quite as quickly as we thought. So that makes yields rise because they had already priced in cuts. They had already thought the cuts were going to happen. Now they don't happen. Yields come up, and the market reacts accordingly. So it's a big forward leading indicator. So you just can't react to everything you hear day to day.
Well, and these will be conversations we're going to have, I'm sure, over the next 12 months, given an election year.
For sure.
People thinking, should I modify my portfolio based upon X, Y, or Z regarding politics? And like Adam just explained, everything has already been priced in on expectations, whether it be geopolitics and things like that. So any decision you're making is after the fact.
So let's talk about some things that hit a little closer to home for people. Maybe not interest rates and flattening of the yield curve, although I guess interest rates do matter, especially as we're going to talk about housing here. So home affordability, Jason, you want to show that?
Yeah,
chart?
I mean, this is really, what we're all seeing with the economy. I mean, besides just the stock market, how are people being affected by what's happening with rising rates? And everyone, you'd have to be under a rock not to realize what has happened with mortgages and mortgage rates. I mean, everyone who bought a home, over the last 15 years was getting very low single-digit mortgages. And now they're 7-8%, especially the people that have adjustable rates. And so what you're looking here now is affordability. What this means is what percentage of the median income in this country is being dedicated to housing. And this is this chart goes back almost 20 years. But it goes, the interesting part for me is this chart is older than the great financial crisis, which was the subprime housing meltdown. And the affordability right now is worse than it was at the peak in 06, 07. So right now in this country, the average American is spending almost 50% of their income on housing, which is insane. Also, what's reflecting, where people are just struggling in this country, and you can kind of see that is also when we're looking at cars, automotive defaults and payments and things like that. What we're showing here is borrowers basically late on their payments, 60 days late on their car loans, because you got to think about it. When people are starting to struggle, and inflation is higher, groceries are up, all their bills are up. Now you think about this. If you've got a mortgage and you're locked in at 3%, and you've got a car, and you can really only afford to make one payment, which one are you going to make?
Yeah.
Right? You're not going to lose your house at 3%. You'll get your car. You're
not going to eat your car. So you got to get
and
groceries.
so right now we're up to about 6%, I think it is, in this country. And this chart goes back 30 years, and it's the highest it's been in 30 years where people are late on their car payments. And so it just kind of shows that the effect of these rates going up truly is having its effect. So it wouldn't surprise any of us if we just see the economy slow down a little bit. It doesn't mean a big correction or crash or anything like that. It just means kind of slow. But the benefit of that is when we're in our bond portfolios, if we have just a slow period of time, we're getting paid a lot more to wait. The interest rates are a lot higher than when we had to wait before, getting 1 to 2% on our bonds.
Yep, which leads us right into cash. So cash has been a big topic. You know, it's come up quite a bit. I mean, if you didn't know, you've been under a rock again. You can and should be getting about 5% now. Money market's paying 5% on cash. If you're not getting 5% on your cash, you should be talking to us. But the one thing about cash is it's a great environment right now for true cash. I mean, true money on the sidelines that, you know, has not been invested and you use for, you know, to keep liquid for any needs that may come up. It's like I said, 5%. It's a huge number. It's the highest it's been in a really long time. But did want to show you a couple of things. Let's go ahead and put up that real return chart. This is a CD chart. So kind of gives you CD rates, and you can see CD rates mirror basically cash rates. This is all the way back to 2004. But the problem is when you start looking at cash yields, you have to also factor in taxes as well as inflation. And when you take out those two factors, you kind of get your real return. So right now it's positive, and you can see it's the first time it's been positive since all the way back to 2008. But that changes quickly. And so we'll kind of show the next chart, which is, I don't think it's this one. Let me go to, let's show yields are temporary. So this is this will show you how quickly yields change. Remember, cash is driven by the Fed funds rate, which is set by the Federal Reserve. That's the short end of the yield curve. But what this chart is showing is how quickly within 2 years you can have a 4% move in yield. And like I just said, we're at 5% now. So those shaded lines, if you started at 5, each of those shaded lines, the cash rate moved 4% within 2 years. So 5 goes to 1. You know, from this point today, you know, 2 years from now, we could be back at 1% cash rate. I don't think we will be. I'm not sure we will be. But again, it's very difficult to predict the future. The point of this is just showing that cash is for cash. Cash is for cash management. And we're doing a lot of cash management for folks right now. And like I said, you should be getting great returns on your cash. But it's not something where you want to take your investment portfolio and go to cash. I think there's one more. Good,
I'm going to jump back because Becca had the chart up that I wanted to take just from that point you just made right now. I've got a long-term history of stocks versus bonds because that's the thing I'm getting right now too. Clients are saying, you know, the market is volatile. This is worried about Israel, worried about Ukraine. There's a lot of things going on with the election. Should I just take my whole portfolio and just put it in the money market or put it in T-bills because it is paying 5% currently? And the point I'm making with this chart here, this is, this is just a 10-year chart of stocks versus bonds. And bonds, you could say that's kind of like your T-bills. It feels good. You know, we always compare stocks to bonds when stocks are down, but we fail to compare them when they're up. And they're up 70% of the time. Or I should say they beat bonds, 70% of the time. And so over a longer period of time, there is a definite cost to having your entire portfolio in cash. And what's even more difficult, what I don't recommend, is when people say, well, I'm just going to go into cash for now. Well, then you got to figure out when to get back into stocks.
And we just talked about the market is a leading indicator. So you go to cash for now, and then you wait for some piece of news that the market had already priced in 3 months ago, And then you decide the timing of the market. I mean, I know we sound like a broken record, but the timing of the market is a loser's game. There's nothing wrong with shifting your portfolio, and that's what we do here for you based on market environments. I mean, whether you add a little more duration to a portfolio, or add a little bit more cash, or add a little bit different types of bonds or different types of investments, but to jump in and out is a loser's game. Let's show one more. I think we have one more there. The short-term investment stocks versus bonds table. Yeah, that one. That should be good. So this is your average return on stocks by decade, average return on bonds, average return on cash. And you can see that, I mean, cash has its place, and there have been times where it's performed well in the 80s, notably because of inflation. But again, we showed you the previous chart with real return. If we had inflation on there, that's probably a negative return. But stocks and bonds have outperformed cash over any significant time period, dating all the way back. I mean, the line there is from 1970 to today, to 2023. Your average stock return's about 10.5. Bonds about 6.5, and cash 4.5. So again, just to make the point on cash, we're not anti-cash. Like I said, we're doing a lot of cash management for people, but it's a different type of investing than a balanced portfolio.
Let's jump to, we mentioned market timing. And so another common question or common concern we're getting is obviously what's going on in Israel. We're moving ships to the Mediterranean, and what if things get worse before they get better. And so, unfortunately, I mean, the country we live in has pretty much been at some kind of military conflict going back to the 1700s, but it doesn't mean that our economy stops, that consumers stop buying stuff, and that the machine just grinds to a halt. And so, people, clients have asked me before, but how do markets perform at the time of war, or if we get into a military conflict, God forbid, what happens? And so a chart here, which it's absolutely insane. When I saw this chart, I had no idea we've been in that many conflicts until you see this, in this many wars. And so what you're looking back here, going back 100 years, excuse me, is every single military conflict we've been in, and then how the market has performed in the background. And so you'll see it sometimes go down, sometimes go up, but really, for the most part, there's no correlation causation from this. You really can't pull anything out. And so I would advise clients not to shift a portfolio based upon the United States military involvement. It just hasn't proven beneficial.
For sure. And as far as something interesting, so thought we'd start to break the news here on our little monthly market matters. So Strong Valley is going to be moving. We're going to move in our office location. That's the big news. The less big news is we're moving about a 5-minute walk away. Yeah, there it is. So we are up hopping on the left there. That's our current building. Most of you have been here, but if you haven't, you can see it's just walking through the parking lot, just around the corner and over to 5 River Park Place instead of 45. So
it's usually the building where our clients go anyway.
Well,
they get lost. When they get lost, it's usually where they go.
We just got them coming here. They get lost over there. We've got them coming here, and now we're moving over there. So
this is going to be the building closest to Friant.
Yeah. So right as you turn in, make your left, and it's right there. So just a little more space. We've grown and we need room to grow. And we'll have the best part is we'll have a dedicated recording studio there. So I think we'll continue with these monthly market matters and our podcast series Roundtable. But I think it'll add a new flavor and it'll be even that much better. So
that's the goal. We can get off these Zoom cameras, and it's not going to feel so Brady Bunch when all 4 of us are in there, and we can actually sit and have a more natural conversation sitting at a table. And I think it's just going to flow a little bit better. It'll be easier to bring guests in, so they're not also on a Zoom camera. And I think it'll be more enjoyable to listen to, because we can just kind of banter and talk about the clients and markets and everything, and just update folks being at one table, having a conversation.
Yeah, no, we're all really, really excited about it. So right now that's scheduled, figure about first week of December. These things go with moves. So we will, we'll send out updates as time goes on, but it's probably, like I said, month and a half away, and then we'll be at our new location. Nothing will change for you guys, but just thought we'd throw the news out there. We're pretty excited about it.
Definitely.
So what do we got upcoming? Let's see. Quarterly roundtable in November. So we'll get the whole crew on here, and we're actually going to bring on our first guest. So this is the idea with the new space as well. This one will still be with the old space. We'll still be doing Brady Bunch Zoom cameras, but we are going to bring in David Lebovitz, who is a global market strategist from J.P. Morgan. Have him kind of break down some of the stuff that we talk about, but again, this is his job, and I think it'll bring an interesting flavor. And we'll ask him some questions, maybe questions that you guys might have, and we'll see how it goes. Then in December also, we'll go back to our monthly series where it's a little bit shorter like this, and we're looking to bring in an expert on the real estate and mortgage market. So again, not just your vanilla prime mortgage, 30-year fixed information you can find on the news. Just, where the market's at, where it may be headed, other ways to access capital, especially for people who you don't, again, the traditional prime mortgage is, look at your W-2 and determine if you have enough income to pay the bills. There are other ways to get loans in this type of environment. So I think that'll be really interesting as well.
Good deal.
All right. Well, hope you guys appreciate it. It was fun. We'll continue to do this. Like I said, next one is the roundtable in November, and we'll get the whole crew on here and David and banter back and forth and see what we can uncover.
All right, everybody. Thank you very much.
Yep. Take care.